from Nashville, Tennessee. Love Nashville, love Colorado. If I had another place to live, it would be in Colorado. I'm here in Nashville. If you haven't been to Nashville, you need to come. It is a great city. But before we get started, I want to say that today I'm very happy to say that both Kurt and Gary, Marilyn, there we go. Kurt and Gary Bedford are the ones who are sponsoring me to speak to this afternoon or this evening. And so I want to thank them very much for their sponsorship. If you read Gary Bedford's on the left side, it'll say this content is developed from sources believed to be providing accurate information. That would be me. Let me explain how this works. I am going to do a presentation and give you some stats and facts. We're going to talk about inflation. We're going to talk about the national debt. We're going to talk about what happens after the pandemic. And this presentation has been approved by compliance. So they've gone through all my slides and they've looked and checked all of my sites. So we haven't made any of this stuff up. My job is to see it before it's obvious. I've been doing this for a number of years, and as has Gary and Kurt. And so when I'm done, if you have any questions, my website is at the bottom of each slide. You'll see markzinder.com. And please feel free to reach out to me through my website. We're not going to do Q&A after the webinar. But if you have any questions at all or want copies of these slides, I'm happy to send them to you. So you can reach me through my website, markzinder.com. All right. Hey, before we get started, 1962, John Glenn climbed aboard a Mercury Atlas rocket. Now, this rocket is 76 feet, 11 inches tall. The top 6 feet, 11 inches, that's the nose cone. That's where Colonel Glenn is going to sit. The rest is a tube filled with 5 million pounds of a highly explosive fuel. Have y'all ever wondered what in the world Colonel Glenn was thinking in 1962 when he climbed aboard that rocket? Listen, I'll tell you what I was thinking. I was 6 years old. I was thinking, gee, I thought that form of jet propulsion was pretty much widely disproven by Wile E. Coyote. That's what I was thinking. All right, so 1962, John Glenn climbs aboard this rocket. They ignite it. They send him into space. He circles the globe 3 times. He splashes back down in the water. They pluck him out of the water. They interview him. They say, Colonel Glenn, what in the world were you thinking before they ignited that rocket? And he replied, and I quote, I was thinking that rocket was built by the lowest bidder. I love that. That's really what he said. Once again, please reach out to Kurt and Gary if you have any questions, or reach out to me through my website. All right, hey, 1999, they were doing the top 10 everything of the 20th century. They did the top 10 books. They did the top 10 movies. They did the top 10 money managers of the 20th century. And if I asked you to name them, you could probably name them. Warren Buffett was number 1. Peter Lynch was number 2. My boss, John Templeton, he was number 3. I also worked with number 8, Michael Price, number 10, Dr. Mark Mobius. Now, when they did this study, there were about 10,000 money managers. These are the top 10. I'll work with 3 of them. Dr. Mobius, 2 PhDs from MIT. I remember the first time I sat down with Dr. Mobius, I said, Dr. Mobius, man, you got to talk to me like I was in 12th grade. And he started talking, and I went, 8th grade, bring it down, right? Sir John Templeton, knighted by the Queen in 1987. He was such a good man. When he passed away, he was worth about $1 billion, donated all the money. He is the founder of the Templeton Prize for Progress in Religion. His first recipient was Mother Teresa. At Templeton, whenever we had a meeting, he would start every meeting with a prayer. And he said, at Templeton, we pray before we buy our stocks, not after. All right. That was Sir John. Michael Price, number 8, didn't grant interviews. And when I sat down with him, I said, Michael, teach me something I don't know. He did 1 interview. He did, I think, Forbes or Fortune. I'm going to talk about him in a minute. But I said, teach me something I don't know. And he said, do you want to learn how to manage money? I went, well, yeah. And he taught me. And guess what? I'm going to teach you. I'm going to teach you what he taught me. All right, so this is another research report that was done just recently, the 5 all-time best fund managers that are retired, and this was done in September of 2021. And Benjamin Graham was ranked number 1. He's the father of quantitative analysis. My boss, Sir John, number 2, and then they're the other 3. we got to jump in with Benjamin Graham, because I got to explain what happened here. He graduated Columbia University, and he went to work for a Wall Street firm, and this is 1915. And he notices in 1915, this is February of 1915, there's a company in Colorado called Guggenheim Exploration. And they mine copper out of Denver, and they're gonna cease operations. They're gonna close their doors, sell their assets, and return the money back to the shareholders. Now, this is 1915, and Benjamin Graham, he's a kid, he's 22 years old, and he said, well, what are their assets worth? They're gonna sell them, well, what are they worth? Well, nobody knows. This is 1915, it's before full disclosure, it's before annual reports, and so he goes to the library at Columbia, and he starts doing research on Guggenheim Exploration Company. What's the breakup value? We call that book value. What's their book value? What's the value of their copper? What's the value of their equipment? What's the value of their real estate? What's the value of their buildings? So this is what he discovers. The stock is trading at just under $69 a share. Well, he adds up the assets that they're going to sell off, and it comes up to $76 a share. We call this an arbitrage. There's a $7 arbitrage. And he goes to his boss and said, look what I discovered. And the boss said, buy 10,000 shares. Let's see how you do. And he bought 10,000 shares. And over the next 4 weeks, they start selling off their stuff. And then they start returning money back to the shareholders in about 4 months. And they got exactly what Benjamin Graham had predicted. And his boss said, can you do it again? And that's when he started doing quantitative research based on what is the breakup value, or what's the book value of these companies. Does this make sense? Because I'm going to show you later on in this presentation why this is important. All right. And one of the reasons, Benjamin Graham, he also was a professor at Columbia, and he only gave 2 students. He only gave 2 A+ in his entire career as a professor, and they both went to the same student. You want to guess who that was? Warren Buffett. Go figure, right? So he was the only one to get 2 A+. Now, Warren Buffett was a student under Benjamin Graham, and Sir John Templeton, my boss. He learned from Benjamin Graham as well. So we're going to talk about some of this stuff today. All right. Equities Magazine. This was an institutional magazine. They're no longer in business. But they interviewed Mr. Templeton. I call him Sir John. So they interviewed Sir John 22 years in a row. And they noticed that he was often right. And the publisher was curious. They said, we've been interviewing this man for 22 years. How many times was he right? And how many times was he wrong? We got 22 years of history we can go back on. So here's the article. Sir John always right. On the upside and downside, Sir John has been seriously wrong once in 22 years. And that was early 1999, when he was positive the overpriced stock market would quickly crash. He was a year early. This is the man that I got to work for. I was his spokesman. My job was to sit down with Sir John, Michael Price, Dr. Mobius. They would tell me how they saw the future, how they saw the economy, what they were reading, what they were doing, and then I would travel the world and I would speak on their behalf. It was really, really a really cool job. Now, in 1962, Mr. Templeton is probably best known for investing in this very small emerging market called Japan. Now, in 1962, if you bought something and it said made in Japan on the bottom of it, it was junk. Right? 1962, Japan selling at 3 times earnings, the US at 17 times earnings. And the public came to Mr. Templeton and said, what in the world are you doing investing in Japan? And Mr. Templeton said, look at the bargains in the Japanese stock market when you compare them against the US stock market. And the public replied, get out of here. You can't compare the Japanese stock market to the US stock market. Things are different over there. 1975, Sir John has half his money invested in the Templeton Growth Fund, invested in Japan. And the public, Japan is selling at 5 times earnings. US is at 12 times earnings. The public said, what in the world are you doing investing in Japan? He said, look at the bargains in Japan when you compare them against the US. And the public said, get out of here. You can't compare Japan to the US market. Things are different over there. 1985, Japan's selling at 33 times earnings. Mr. Templeton starts to get out. 1986, Japan's at 40 times earnings. Mr. Templeton's completely out of Japan. 1987, 88. Remember this? Japanese companies are buying American companies. They bought Pebble Beach. They bought Rockefeller Center. We were emulating Japanese management styles. We wanted to be Japan. We were eating sushi like we love this stuff, right? 1988, Japan's selling at 75 times earnings. 1989, they're trading at 100 times earnings. The Nikkei's at 39,500. And they came to Mr. Templeton and said, you got out too soon. You got out too soon. And he said, there aren't any bargains in Japan when you compare them against the US. And the public replied, get out of here. You can't compare Japan to the US market. And then they uttered what Mr. Templeton says are the four most costly words in the English language. They said, it's different this time. Never different. In December 1989, the Japanese market started to correct. It was at 39,500. It's still below 30,000 today. It's 29,500. So that's what we're going to talk about. Is it different this time, right? Is it different this time? We're going to talk about four things. Hey, this is on everybody's mind. Now, my job is to do what I call second level thinking. What Sir John told me is, hey, listen, are you reading the same thing your clients are reading? Are you reading the Wall Street Journal? Your job is to go deeper. I want you to read, what's going on at the Federal Reserve, U.S. Treasury, National Bureau of Economic. That's where I get my news. So I'm going to talk about inflation. And my job is to tell you stuff that you may not know. I'm going to talk about the national debt. This is interesting, right? And that's always the very first question I get. What about this debt? And plus, we just signed a $1.2 trillion infrastructure bill. What's that going to do? Right? And then we're going to talk about what's happening now. And then we're going to close with what happens after the pandemic as I shimmy out on a very thin limb and try to make my prognostication based on history, right? And so all of this is going to take about 43 more minutes, all right? So bear with me. I talk fast, but you're going to love this stuff. Let's talk about inflation. There are 5 different types of inflation. There's inflation, there's deflation, there's hyperinflation, there's disinflation, and shrinkflation. Shrinkflation, yeah. We're going to talk about shrinkflation. All right, inflation. Let's do inflation first. What is inflation? Is more money chasing after the same number of goods. Economics 101 in its most basic sense. I know it's the expansion of the monetary system, but the money supply, but more money chasing after the same number of goods. People, let me explain something called the base effect. Right now, we saw inflation numbers come out really hot. Gasoline prices, year over year, up 49.5%. Oh my gosh, right? Real estate equivalent rents, there's something called the base effect. Let me explain the base effect. They're using year over year numbers. Do you all remember what was happening in April of last year? Let me remind you, oil prices went negative. We weren't driving, we weren't flying. We had so much oil, there was no place to store it. Oil companies were paying companies to take it off their hands. Now, this time last year, when it went negative in Nashville, we were paying about $1.25 a gallon, right? Then by this time last year, we're paying $1.89 a gallon. Well, now we're paying $3.19 a gallon, $3.29. That's what we're paying in Nashville, right? But they're using the $1.85 year over year. Well, is that a real number? No. Because listen, before the pandemic, it was at 319. Now it's at 329. So it's really up 4.1% if you go back 2 years. That's called the base effect. And that's why you're seeing these hot numbers, is because the numbers are basing them on, were artificially low because of COVID. All right. So remember, April 19th, 2020, oil prices went negative, the base effect. All right, supply and demand. There's an old joke from like 1905. That said, hey, you can teach a parrot, a minor bird, to be an economist. Just teach them to always say supply and demand after every question, right? So supply and demand. One more thing. You are not the only people that know that there's a logistics problem and that there are over 100 ships waiting to be offloaded off the port of Los Angeles, right? We all know this. We see it in the news every single day. So retail organizations, Black Friday, this is when they go in the black, when they start making money, they're nervous that they're not going to have enough product to sell in their stores. And you may not know this, but you know that 87% of all retail sales still occur in physical stores? Oh, yeah, only 13.3% actually happen online. Yeah, you're going to check that. I promise that's true. And so what do these companies do? They bought twice as much stuff.
thinking that, well, maybe this stuff will come in from this port versus that stuff coming in from that port. And so they're hoping to get half as much stuff, at least half of the stuff, right? So they'll have some stuff to sell. Makes sense. This is what you would do too, right? Makes sense. Well, what's the problem with that? Supply and demand. Well, what happens 3 months after the holidays when all that stuff that wasn't offloaded starts hitting the stores? Now you're going to have excess supply. What are prices going to do? They're going to come down. Oh, just think about that. Just think about that. Think about the base effect. Think about supply and demand. All right. So be careful about, this is what's going on now. Be careful about reading the news and extrapolating that into the future. And then labor costs. Lastly, let's do this real quick. The cost of making something, 25% is the cost of labor. The cost of services, getting your nails done, getting your hair done, 50% is the cost of labor. Here's the problem with that. Those prices aren't going to come back down. 83% of Americans now make $15 an hour or more. The average hourly wage is $31 an hour. And so you're not going back to 7.25. You're not going back. However, in this last report that just came out a couple of days ago, labor cost actually came down a little bit. Oh, all right. But I am nervous about labor costs because that's sticky, where this other stuff might be transitory or temporary. All right, let's move on to deflation. Deflation is basically, a general decline in prices. You'll love this story. I'm going to do just a little bit of economics. I promise you're going to love this story. That's post-World War II. Everything above the baseline is inflation. Everything below the baseline is deflation, prices coming down. That's post-Civil War. All they knew was deflation. Now, bear with me. I'm going to do a little bit of economics here for you, but bear with me. How would you get out of deflation? Well, you would print more money. Printing money is inflationary. But we couldn't do that in the 1890s because our monetary system was built on the gold standard. You can print 4 paper dollars for every 1 gold dollar you had in reserve. What's the problem there? California gold rush, 1849. We pulled more gold out of the ground in 3 years than the previous 300 years combined. Wow. So what's happened to gold prices? They're going down. Well, we want to get out of deflation. We want to print more money. By the way, deflation, you're thinking, oh, no, that's good. Prices are going down. That flat screen TV that was $10,000 was brand new. It's $200 now. All right. What if you're a farmer? What if you plant your seeds in the ground now, but you don't harvest your crop for months, and during that period, prices come down? Well, that's bad for you. What if you're a manufacturer? You buy raw materials today, by the time you've turned it into something and go to sell it, prices have come down. That's bad for you. So deflation is worse than inflation. How would you get out of deflation? Just bear with me. You're going to love the story. How would you get out of deflation? You would inflate your monetary system. Couldn't do that because of the gold rush, and we were pegged to gold. So in 1896, William Jennings Bryan runs for president. He's a Democrat. He's at the Democratic Convention in 1896. He's proposing we get off the gold standard. He wants to go on a bimetal standard. He wants to peg 16 ounces of silver to 1 ounce of gold. Silver was stable, gold's going down in value. He riles up the audience. It was the famous Cross of Gold speech. And this is what he said. You shall not press down upon mankind the brow of labor, this crown of thorns. You shall not crucify mankind upon a cross of gold. That's what he's talking about. Get off the gold standard. All right, ready? This is where it gets fun. 1900. A man writes a book about it. And the man's name is Frank Baum. And the title of his book is The Wonderful Wizard of Oz. Oh, you thought that was a children's story. No, that's a social commentary on monetary policy dating back to the 1890s. Let me explain Wizard of Oz. OZ, ounce of silver, ounce of gold. Follow the yellow brick road, the golden road paved to where? The Emerald City, Washington, D.C., where they printed the greenback at the time. Dorothy was an activist out of Kansas City. Her real name was Leslie Kelsley, and they called her the Kansas Tornado. I'm not making this up. On Dorothy's journey, she passes by the Scarecrow, the American farmer, the Tin Man, the American industrialist. The Cowardly Lion was William Jennings Bryan. The Winged Monkeys were the American Indians. The Munchkins were the little people. It was the U.S. population. It was you and me. In the book, her slippers are made out of silver, but because Technicolor was invented in 1935 and the movie produced in 1937. They made them ruby red so they would jump out at you. Ladies and gentlemen, that is not a children's story. That's a social commentary on monetary policy dating back to the 1890s. How cool is that? All right, let's do hyperinflation real quick. Hey, Germany, after World War I, was required to repay for their war crimes from World War I, and they went, this will be simple. All we have to do is just print more money. So they just started printing money. This is 1921. This is 100 German marks. That would buy a family of 4 enough groceries for a week. This is 1922. This is 50,000 German marks. That would buy a family of 4 enough groceries for a week. This is 1923. This is 2 million German marks. And it took a wheelbarrow full of these to buy a loaf of bread. You print too much of it, causes inflation. Printing way too much, hyperinflation. Here's a picture of a woman stuffing her stove with money because it was cheaper to burn the money than to use it to buy coal with. Here they are just sweeping the streets of money. Now, that would never happen today. Everybody knows better. I'm about to show you a picture of the largest single note ever produced and released into the public's hands. This is from the country of Zimbabwe in 2008. This is $100 trillion. The exchange rate is basically 47 cents today. You can buy them on eBay for like 50, 60, 75 bucks. It's fun. Here's a picture of a bathroom in Zimbabwe. I love the placard over the toilet paper only, no cardboard, no cloth, no Zimbabwe dollars. Not even worth the paper is printed on. All right, disinflation. Now, the Great Recession, the Federal Reserve created $3.9 trillion of new dollars. You know, that should have created inflation, but it didn't. There wasn't inflation, there was disinflation. Prices were coming down. Why? All right, let's look at 3 different indexes. You have CPI, Consumer Price Index, PCE, 1959. This is the one that's favored by the Fed. And then you have DPI. I want to talk about that. All right, CPI is Consumer Price Index. PCE is the Personal Consumption Expenditure Price Index. And DPI, what is DPI? Have you heard about it, DPI? This was created by Austin Goolsbee, who was President Obama's chief economic advisor, and is called the Adobe Digital Price Index. And what Austin Goolsbee discovered is the stuff that's happening with CPI and PCE, they're not capturing what's going on online. All right, so he said, he teamed up with Adobe and said, all right, let's take a look at what's going on online. They analyzed trillions of online transactions across 100 million different product SKUs on 1.2 million different products. CPI, 80,000 products. This is 1.2 million. I think this is pretty inclusive, right? This is what they discovered. For a 5-year period from 2014 to 2020, consumers saw an annual increase of 4% in digital purchasing power. Now, this is what that means. Goods that you would have paid $1 for in 2014 cost you 80 cents in 2020. Remember, the past 10 years, prices, they're not in negative, they're not deflation, but we've been at 1.5% inflation. You know, oh my gosh, you know, this is the reason why. Ever wonder why the government wants 2% inflation? Why do I want inflation? Let's say you work for me, I pay you $100,000 a year. Inflation is running at 5%. You come to me and say, I need a cost of living increase. And so I'll give you a 5%, I give you a $5,000 raise. Government can tax that. Let's say we're in deflation, prices coming down 5%. Well, you're not going to come to me and ask for cost of living increase, but your cost of living just improved by 5%. Government can't tax that, can they? There's one reason. All right. So what I've done is, this is the Adobe Digital Price. I'm going to look at 14 different categories. There's your baseline. Everything above the baseline is prices going up. Everything below the baseline, prices coming down. You can see one item, flowers and related gifts. Those prices have been going up. These other 4 categories, prices have been coming down the past 5 years, 5, 10, 15, 20, 25%. All right, here's another one. There's your baseline. One product, groceries going up in price. These other 4 going down 10, 20, 30, 35, 40%. One more, here 4 more. There's your baseline. Everything going down in price. Why? Well, when we would go to different physical stores, we'd shop 2 or 3 different stores. Now you got the entire world at your hands, right? Prices coming down. Now, being fair, so far this year, prices are up 4% on online sales. All right, okay. All right. Shrinkflation, this is what we've been waiting for. What in the world is shrinkflation?
Hey, we pay attention to the price. You don't pay attention to the weight, do you? All right, I love this. So let me just show you some things where the packaging has been, the contents have been changing in size. This is Cinnamon Toast Crunch. Used to be 19.3 ounces, now 18.8. Prices stayed the same. Right? Maybe you've noticed this, right? No longer 6 bagels in that pack of bagels, right? So here are some, I get this from Consumer World. And so prices are the same on these products. This is just the first page. We're not going to go through them all. Ragu spaghetti sauce, same price, was 28 ounces, now 24. Powerade was 32 ounces, now 28. Star-Kissed tuna was 6 ounces, now 5. I love this one. Haagen-Dazs ice cream. Have y'all gotten the pint of ice cream yet? And you go, hey, what's that air pocket doing to my ice cream? Well, listen, if they put less ice cream in there and you open the lid, you would notice. Now they can make the package smaller, but then they have to make the box that it goes in smaller, the master box that it goes in smaller. They have to reconfigure the truck that it goes on. Then when it gets to the grocery store, they need to renegotiate with the grocery store about how much they're going to pay, you know. And so rather than do all of that and make the packaging smaller, they just fill less of it up. And then what they do, here we go. They turn it upside down. So when you open it, you don't know that it's not completely full. That's shrinkflation. Oh my God. All right. Let's do the national debt real quick. Y'all know who this guy is. You don't know his name, but you know who he is. He is the doctor who was financially, his back was against the wall, and he wrote a white paper, and he said, I believe there's an association between the measles vaccine and autism in many children for several reasons. That's your guy. It's been proven to be false, but 90,000 children in America go unvaccinated because of him right there. All right. This is Ken Rogoff and Carmen Reinhardt. Rogoff and Reinhardt, 2 PhDs, one from Harvard, one from MIT. They wrote this paper called Growth in a Time of Debt. And they basically said a country's whose debt to GDP exceeds 90%, debt to GDP exceeds 90%, that country goes into recession, higher interest rates, high inflation, right? Now, this guy's Thomas Herndon. He was a PhD student getting his PhD in economics at UMass Amherst. And when you're a PhD student studying economics, they say, hey, here's a white paper. I want you to replicate the findings. He was given the Reinhardt and Rogoff paper, and he couldn't make the numbers work. So he gave it to his girlfriend, who was also getting her PhD in economics at UMass Amherst. She couldn't make the numbers work either. So he called Reinhardt and Rogoff and said, may I have your data, please? And they sent him his data, and they uncovered data omissions, questionable methods of weighting, elementary coding errors. They found math errors, right? That paper has since been pulled. But we still quote it all the time when a country's debt to GDP exceeds 90%, right? It's not true. It's not true. You can't even find the paper on the internet anymore. It's been pulled. All right. So what about our national debt? No one ever asked me, what about our national assets? All right. Let's go through some. We got above ground assets. We have below ground assets. So let's go through some of the values of what the US government owns in America. Mineral rights are coming in at $128 trillion. Real estate, of the 2.2 billion acres, the US owns 28% of the landmass in America, 80% of the landmass in Nevada, 61% of the landmass in Alaska, 48% of the landmass in California. Have you all seen the price of California real estate? Right? That comes in at $23 trillion. Taxes last year came in at just under $4.1 trillion. You got gold at $500 billion. So basically, you got, do this here. So what are our nation's assets? Coming at $269 trillion. So you got $269 trillion and $23 trillion in debt. If you're a banker, would you make that loan? All right. So I'm not as concerned about the debt because we're about to spend $1.2 trillion on rebuilding our infrastructure. And I'm not concerned that it's going to cause hyperinflation. We are going to see inflationary pressures around the world, just keep in mind, but I'm not, a lot of people are concerned that we're spending too much money. Keep in mind, well, all right. So what's happening now? Donald Rumsfeld, God bless him, just recently passed away. After 9/11, he said, there are known knowns, there are known unknowns, and there are unknown unknowns. And he was chastised for saying that. And then people went,
That's kind of good, right? There are things that we know that we know. There are things that we know that we don't know. And there are things that we don't know that we don't know. All right. So let's do this first. The known knowns. Michael, hey, Michael, teach me something I don't know. Do you want to learn how to manage money? And I said, well, yeah. And you said, all right. Here it is. I promised at the beginning. He had me write that number down, 2.38. What he's basically saying is historically, the stock market is traded at 2.38 times book value. Remember early in the conversation, Benjamin Graham, number one on that list, the father of quantitative analysis. What are the assets worth? And so historically, if the company's assets are $1, the stock should be trading at $2.38. There it is. There it is. So there's your norm. Value investor like John Templeton, Benjamin Graham, Warren Buffett, they consider the stock cheap or the market cheap if it's trading at 1/2 the norm. They consider it expensive if it's trading at twice the norm. And so where are we today, you might want to know. And as of today, the market is trading at 4.79 times book value, or right there. Now, whoa, before you get nervous. And I'm bullish long-term. Bull bear, you know, the term comes from when a bull attacks, it attacks with his horns in an upward fashion. When a bear attacks, it attacks with his claws, downward fashion, bull and bear. All right. So I'm still bullish long term. I'm a little nervous short term, right? And that a lot of reasons. This is one of the reasons, right? And also, the second year of a first-term president is always the weakest of the four. The third is the strongest. That's because he does what's popular. He wants to get reelected, right? And so I'm a little nervous. So talk to Kurt and talk to Gary about maybe doing a little protection on your portfolio. But right there, remember this stat, Sir John has only been wrong once in 22 years. That was right there. You can see right there and across that line. Here's the reason I'm not so nervous about this, is because we just tipped the scales just this quarter, where we used to be an industrial economy. We made stuff, right? We made stuff. Today, we're tipping towards a service economy, right? With information technology. And so with information technology, you don't need factories and real estate, and you don't need manufacturing plants. And so because of that, we can safely say, well, those companies don't own stuff. And so you can't use really price to book on them and keep the old historical numbers. So that's why these numbers are high, because companies like Apple and Google, that don't manufacture stuff, are trading at a high price to book value. Got it? Once again, have any questions? My email address is mark@markzinder.com. You can reach me through my website as well. All right, the known unknowns, historical correlations. Don't know if you know this, there's something called the Santa Claus rally. Hey, the holidays are upon us. If the 5 days after Christmas are positive, then usually the market is positive, and that's been correct for the rest of the year, and that's been correct 89.3% of the time. So 5 days after Christmas, the next year, the market's positive. That's been correct 89% of the time. Hey, as goes January, goes the rest of the year. That's been accurate 88% of the time. I love this one. This the Super Bowl indicator. If I forget if the original team that was a part of the NFL wins, something like that, then the market goes up. That's been right 40 of the past 53 times. And then sell in May and go away, right? I love this. Since 1945, the S&P has climbed an average of 6.8% in the months of November through April. How cool is that, right? Right. Now, ladies and gentlemen, we call this data mining. You tell me what the answer is. I'll go find the data to support it, right? Look at this. Look at this. This is fun. This is really fun. Look at the correlation between these two things. Look how well those two things are correlated. What you're looking at is the per capita consumption of cheese and the number of people who die by getting tangled in their bed sheets. Love that. It's called data mining, right? So be careful about this stuff. Just be careful about this stuff. All right. The unknown unknowns. Ooh. What happens after the pandemic? I don't know. I got some ideas. So let's close out with talking about what happens after the pandemic. Give me 5-7 more minutes and we're done. And once again, if you have any questions, just reach out to me, reach out to Gary, reach out to Kurt. You're here to help. We're here to answer your questions. The bubonic plague, half the population perished. We all know this. We learned this in high school. It was half the population died. Now, I want to put that number in perspective for you. If you go back from 1900 to today in Europe, include World War I, include World War II, include the atrocities of Hitler, Mussolini, Stalin, include Bosnia, include all the deaths and all the war in Europe in this 120-year period, it equals 3.7% of the population. To have 50% of the population perish, that would be equal to 20 world wars. All right. So, just like today, back then, it wasn't equally divided. It was 70% of the serfs and peasants died. Basically, 30% of the noble and landowners died. Right. So this was interesting because there's something called, so what happened after the plague, right? You have human capital and you got physical capital. Human capital is what we just talked about. This is the people working. Physical capital is, hey, if you were a landowner before the plague, when the plague was over, if your land was fertile before, it's still fertile now. If you were a cobbler and made shoes, you may have passed, but your tools are still there. So human capital, physical capital, right? The human capital is gone, the physical capital still exists. So the problem is only 30% of the serfs and peasants who work the land are still alive. They got the upper hand. They can demand more money to work your land. They would say, you want me to work your land? You got to give me more money. Well, that didn't go over very well. The nobles and the landowners went, a peasant's going to tell me how much I'm going to pay you? So they made this law. It was called the Ordinance of Laborers. And they basically, it was a maximum wage law. And they said, okay, you can't charge more than this. And if you're a landowner, you can't pay more than this. And so they went, oh, all right, well, if that's the case, then I need an ox. You have to give me an ox to help farm the land. Oh, so they got an ox. And so productivity improved. Now, if you look at this picture closely, you'll determine that this was not taken in 1349 because of the telephone pole. You can see the telephone pole in the background. That wasn't invented yet. All right, so just joking. All right. So, and so they said, well, the Shire down the road is willing to pay me more money. I'm going to go down there. And so they would go there and they started making more money, kind of like what's going on today, huh? Right. And that didn't go over very well either. And oops. And so there was another law, and it was called the sumptuary laws. And they said, okay, if you're a peasant or a serf, you can't eat guinea fowl. You can't wear purple. Purple's for royalty. And they went, forget that, right? And so now all of a sudden wealth is being created. Hey, if you're a guild member, the guilds were closed. If you're a cobbler and you made shoes, your father made shoes, and the father before him made shoes, and the father before him made shoes. Well, now all of a sudden the shoemakers are dead. And so the guilds opened up. And so they let people come in and learn a trade and become an artist and an artisan. And they were making more than shoes. They were making saddles and they were selling their wares in the town fair, and they were creating wealth. And so the landowners, those that had passed, they were subdividing the land. Guess who was buying the land? The serfs and the peasants were buying the land, and they were creating wealth. And this period, ladies and gentlemen, is called the Golden Age of Labor. This has happened 3 times in history. During the plague or after the plague, World War I, World War II. Young men would go off to war, fewer came home. The economy was ready for an expansion. There were fewer of them. Labor had the upper hand. I think this is exactly what's going on today. And I think, I showed the picture of the ox. I was reading a story recently in Dallas where there's a construction company that can't get supervisors. And so they're offering the Ford F-150, come work for me. So yeah, history repeats itself, right? All right. So the problem today, of course, is I quit. People, why? You're seeing this and you're wondering why is this happening? Well, think about this. Think maybe, and I don't know if you know this, but 1 in 7 service industry, waiters, wait staff, bartenders, 1 in 7 quit last month. 1 in 7 quit last month. Why? Well, tips, they work on tips. Do you know what TIP stands for? TIP stands for to ensure promptness, right? Usually a tip was given before the meal. You bring them my food quick. Well, now what's happening is we have fewer waiters, you have fewer people working in the kitchen, your food's not coming out as fast, it's not coming out hot, so you're not leaving a good tip. And so these wait staff are going, why am I working weekends and nights if I'm not going to make any more money? I'm going to go take one of these jobs for offering a $5,000 signing bonus, right? And paying $15, $16, $17 an hour. So we see this revolution going on, and this is going to work itself out, and this will be good for the economy, and you're going to see reduction of income inequality. All right. From 1352 to 1440, you saw a reduction of wealth inequality. And this led to the Renaissance. Ever wonder what was the awakening? What was the period that caused the Renaissance? Here it is, right here. People would be wandering through the forest. They happened upon a town. Everybody was dead. So there was nobody in the town. And there was a church there, and the church had the books. And so they'd go into the church and had all these books. Well, if you wanted to read them, you had to learn how to read, right? And there was no spine that explained what the book was. There was no table of contents, right? And so if you want to know what was in the book, you had to read the whole book. And that led to the printing press in 1440 and the Renaissance. It was all because it all started with the plague in 1347. I think we're moving in that same direction. I really, really do. All right, listen, my time is up. So is it different this time? Yeah, maybe so, maybe not. All right, so with that said, once again, I want to say thank you very much. I greatly appreciate it. And I want to say at this point, we are done. Thank you for attending. I greatly appreciate it.